Hey guys, are you struggling with negative items on your credit? I'm going to talk about that today and show you how to get started on that journey to improving your credit. So let's get started. Well, first, I want to welcome everyone who's been on my channel before. Welcome back. For those of you who are seeing a video of mine for the first time, welcome. I hope that you find everything here valuable and helpful. And if you're struggling with improving your credit, which I think we're all working to make it better, keep it better, and make it, well, I'll say make it better and keep it better. Put it that way. Um, Now, for those of you who've seen my other videos, you know what I believe. Better credit means a better life. And a better life means a better home in a better neighborhood, better schools, a better car, better finances, better vacations, all of the fun stuff. Plus, we got to get to the important stuff as well. So, but I'm going to diving into a topic that affects millions of people. And that's how to effectively dispute negative items on your credit report. Now, there's two types of negative items on your credit report. There are truths and then there are errors. There are negative items that don't belong there, and there are negative items that we don't want there, but we have to take care of them and address them in a meaningful way to have them removed from our credit reports so that we have the best file. Again, those who see my other videos, you know I talk about file quality, file strength, file health. You can plug in any of those numbers. And when you have good file history, you have a strong credit file with quality accounting on there and a healthy file. No matter whose scoring model you use, you're going to have good scores. But the focus is on the file. The scores are a byproduct. Just remember that. And if you do it that way, I guarantee you will get the credit score that you want. You can earn the credit score you deserve, and that you'll be able to have the better things that you want. But remember, credit is more than just about buying stuff. It's about leverage. It's about using credit to leverage your income and leverage your savings and leverage your other assets so that not only will it cost you less to borrow money and buy things when using credit, but that you buy things of value with your credit and not just more consumer items that you'll use and throw away. But again, that's for a later discussion. So, um, if you're ready to take charge and change your credit and improve your financial health, this is the episode that'll help do that. And I'm going to try to break everything down step by step. But I always like to tell people that I use the word step by step, but it's really more about moves. Because if you think about credit restoration, if you think about credit repair, it's all about steps. And the problem with steps are with when a person takes a step, they often expect a reward for each and every step that they take until, like in a staircase, you go a step, you know how many steps are left, and then you're looking for something at the top. Even though you know you're going to be done at the top, people still look for rewards and credit repair at every step. And I can tell you that in true credit restoration, where you're really, really, really improving your credit overall to have the best credit you can have, you don't get a reward for every step you take. And a lot of folks, they quit because they make a step and then they expect a boost to their scores. And then when they don't see those movements, they give up. Whereas credit restoration is more like an escalator, where when you're on the escalator and it's moving up, you're not expecting your benefit till you get to the top, because the escalator is designed to get you from the bottom to the top. Stairs are designed to get you from the bottom to the top, but you expect something to happen at every step, but you got to go through all the steps. See the distinction? Steps, no reward, even with steps, there's no expected reward to the top. There's no reward at the top for steps, There's no reward but at the top for the escalator. But people look for a reward at each step, when no one looks for a reward at the escalator until they get to the very top. I hope that metaphor helps. I know a lot of people that I've explained it that way, they find it helpful in terms of mindset, outlook into the credit repair process. But people often quit too early because they're waiting for the magic. They don't wait for the magic to happen. And I talk a little bit more about that. Think of it this way. I've talked in my videos, I like to use the example about the bamboo. Now, a lot of people don't know that bamboo is a grass. A lot of people that do know bamboo is a grass, but don't know about the unusual, I shouldn't say unusual, but the surprising growth cycle that bamboo have. Now, bamboo, there are different varieties. They average from 4 to 15 years, but I'm going to talk 4 to 15-year life cycle. But I'm going to talk about the 4-year bamboo. There's one variety of bamboo. When you plant the seeds, that seed grows in the ground. It never comes above the ground for 4 years. But all the time while it's growing roots. It's growing out this way. It's growing in all directions, right? We don't see it. We don't see that growth. And so if one didn't know any better, they'd be like, oh man, this bamboo, it must have died. It didn't grow. And so for 4 long years, it's growing roots. It's growing a strong root system, like I said. Then year 4, day 1, suddenly we start to see a sprout emerge. Now, and it doesn't come up. It comes up a little bit bigger than the sprouts that you see on most plants, because that sprout is coming off a 4-year-old seed that's growing, and it's growing crazy. And so what happens is, once that bamboo shoot comes up, it starts growing, and it's growing at a rate of nearly 3 feet a day. And it's going to continue to grow 3 feet a day for 60 days. So all of that slow growth of the seed underground, all of that root system development is designed for one thing: to support a rapidly growing bamboo shoot which becomes a stalk that'll grow massively in the next 60 days. Then after the 60 days, the plant is done. It doesn't grow anymore after that. But that's the code. And that's how you got to look at anything in life that you want. Usually works in that way, where you do a lot of work underground in the dark with nothing to show for it, but you're building a strong root system. Or if in the case we talk about a house, you're building a strong foundation. You ever see a building go up, you see they spend months and months and months and months just doing the foundation. There's no building being built. All you see is foundation. Then suddenly, once that foundation is done, then they start building the building. It goes up quick. Life is the same way. When we give up short-term pleasures and comfort to build a foundation or a root system that will support our long-term growth when the time comes. Credit is the same way. You work on it, you're working on it, you're clearing up things, you're managing your accounts, and you're going to slowly get things in alignment, and then suddenly your scores are going to grow quickly. People that are looking for instant, quick growth with credit, most of those things don't work. Most of them are temporary. Most of them don't work. They're not hacks. True credit comes from building the root system and then growing the stalk and growing that credit file with a history of positive activity that supports somebody who is effectively managing their finances and by extension their credit, or I should say managing their credit and by extension their financing. And then they will be the ones with higher scores, better credit reports, and being extended credit to do all sorts of things to have a better life. So, having said all that, let's talk about these things first. So, first things first, let's talk about why that's important. Obviously, anybody in the world knows that your credit plays a huge portion of your financial life. Now, while I have had plenty of clients who had good credit or good financing, high income, but terrible credit, mostly because they only use their credit on occasion and usually in the most negative ways, and they're never concerned about it because they always know that they got income and cash that they can fall back on. So for them, their credit becomes an afterthought. But then when a time comes when they really need the credit, it's not handled. And they say, well, I never really cared about credit because I got money. And they don't understand that credit is a leverage. So no matter how much money you make, if you got earned income, unless you're ridiculously wealthy, credit, the personal credit is important because unless you don't care about prices, unless you don't care about rates or anything like that, and you just say, hey, I pay whatever, which is fine. But for most of us, credit is important to leverage because we have limited income and we have limited assets. So when you got limited income and limited assets, you can use credit to leverage those that limited income and those limited assets to try to grow to virtually unlimited income and assets when used properly. So credit is more than just buying stuff. Having good credit is more than just buying a bunch of stuff you don't need. In the financial circles, credit can get things done faster than cash. I mean, just think about it for a minute. Even if you made $100,000 a year and you wanted to buy a $100,000 house, how long would it take for you to save for $100,000 house and have all cash if you only earn, even if you earn $100,000 a year? Of course, we know that $100,000 salary income, it didn't all go in our pockets. So it may take you, even if you live frugally, it may at least take you 3-4 years possibly to save up the $100,000 cash, when instead of waiting 3 or 4 years, you could have, if you got good credit, you could borrow $100,000 in 3 or 4 days and then buy your home. So that's the power of leverage, with credit leveraging your income. So, but again, back to what we're saying, credit plays a huge role for that reason, you know. But here's the bigger part. The best credit you got, the best terms you'll get. Because if you had good credit, then you'll have no problem getting best rate. Here, I'll give you an example. Okay. It's a mortgage example. So suppose I was talking about that person with the $100,000 income. Suppose they were looking to buy a $160,000 house, right? I use that 160, 100, it doesn't matter. But say an example, $160,000 house. Now, if that person's credit, assuming that their person's credit is good enough to even get an approval in the first place, suppose their credit is, say, 580, which is the absolute bare minimum that FHA will allow, credit score that they will allow you to have to even consider you for a mortgage approval under their guidelines. So you're at 580. And like, say for instance, at 580, where the market, where interest rates right now are currently in the market, say that gave you the ability to qualify for a 8.5% loan, right? So an 8.5% mortgage for 30 years at $160,000 is roughly about $1,153 a month, right? $1,153. That's what it would cost you just for the mortgage part. And that's not even talking about taxes and insurance. That's just the mortgage, principal and interest, the regular loan payment part of it. Just like if it was a car, it would be, the car loan. There's no other stuff. So it's principal and interest only part of the loan, 1153, 8.5% for 30 years. Now, you take that same person and now, that same scenario, and now you have a person who has a, say, 680 score, 100 points higher, 650, 680, nearly 700. And with today's rates, say with the current rates, that 680 score will get you an 8.5% mortgage. I know they're not quite there, but if you got high risk, that's about where you would land. And again, that's just 2% points difference in interest rate on the same loan, $160,000, 30 years. Well, you do the math, a $160,000 loan at 6.5% interest is $983, give or take. Right? So 8.5%, 1153. 6.5%, 983. That's a huge difference. I mean, that's $205 a month difference just on 2% interest rate. So when people say, is it worth getting your credit fixed? Or my credit is good enough to get me a loan. Is it worth getting it better? Why should I pay someone to help me get it better? Why should I take the time to get my credit better? Well, just on a mortgage, assuming you could get one, $200 a month. And remember, that's $200 a month for the next 30 years. That's 360 payments. $200 times, we're talking about, $2,460 a year in less payments just by having a 2% better interest rate. We're talking about $73,000 over the life of the loan, if that's assuming you went to whole 30. Now, I know most people don't necessarily go 30 years. They may refinance, other things like that. Those are always options. But again, even when you refinance, you still got to have better credit, or the refinancing will be for nothing, even worse than what it is to do it anyway. I mean, refinancing is not horrible. It's just the part about restarting over costs you interest, because you're paying all your interest and interest up front at the beginning of the loan. You pay hardly any principal in the first 5, 6, 7 years of your loan on a mortgage, on a 30-year mortgage. So if you don't have good credit now, you got to have good credit later. So you can't, even refinancing out of those situations won't help if your credit is not up to snuff. So when people say, oh man, I got to pay off this stuff to fix my credit, I have to, pay off things to fix my credit. I want to save that money, because they don't want to pay what they owe. But by paying those things, if they're needed, should they be, we've gotten them verified and validated, should they be needed to be paid off, they can't be disputed away, it's still worth it to pay them, because by paying $2,000 or $3,000 that you owed anyway, that's why it's on your credit report, you'll have the opportunity to save thousands of dollars in the future. Then that's just on the mortgage. We're not even talking about credit card rates, which they're going to be high no matter what. That's just the nature of it's unsecured borrowing. But car loans, I mean, that's the difference in 70, 80, $100 a month between having a 580 score and having a 680 score. So it's important. I just wanted to point that out. But back to what we were talking about specifically, we're talking about disputing things. But the idea was dispute to clear up your credit, to get better credit file, higher scores, to get you better refinance. But back to disputing. So now, of course, we know that when we're disputing, our first goal is to dispute errors. Because if we look at our credit report and we got negative items that are in error, they don't belong to us. Take me, for example, back in the 90s, well, in the late 80s, when I first started building credit, if you will, my credit started out good. I had one card, and then I ended up financing a car, brand new. Everything was great, had no problem. Everything was good. And then suddenly, when I went to buy my first home, first property, and I got declined right away because they told me I had issues on my credit. And I'm like, what kind of issues? I only have 2 accounts and they're both paid, were paid on time and in full. Well, it turned out that there were a handful of credit account items that did not belong to me. They belonged to someone else who had the same last name. Again, we're talking about the 80s. And so apparently they had similar last name, and I think maybe even similar social security number or something. But in other words, these negative accounts were on my credit, and they pulled my scores down. And initially, it took me almost a year just to even see these things because there was no credit monitoring back then. There was no way you could see these things. You had to write letters and ask them to request a copy of your credit report just to see what it was, only to find out it was in error, like I told you. Then it took me another 2 years to get those off, and had to write letters and say, this is not me, I don't know what that is, this person is in another state, things of that nature. It just didn't make sense. It was easy to see that it wasn't me. And but the dispute process back then was that it was writing letters and saying, hey, show me where this is me. And it took me nearly 2 years to finally get that cleared up. And then I was finally able to get a mortgage on the first property I bought that was financed. I bought properties before that cash, but that was the first property I bought financed, and everything was good there. And then I subsequently bought a couple of other properties financed, and then things started popping up again. By this time, it's in the late 90s. And so I had issues starting to pop up again with false items. And I had a note in the file that says check social security number first. So I was able to get those things removed fairly quickly. And then when they made changes to the credit, when the Credit Reporting Act came into play, they changed everything. They made credit reporting companies and creditors more accountable. And so it cleaned up a lot of that. It cleared up a lot of the errors, but errors still do exist. I mean, they estimate somewhere around, last time I read, as of this filming, they were estimating up to 25% of credit reports have errors of some kind. So we want to make sure we do that. Now, that's why checking your credit, checking your report, and disputing inaccuracies is very crucial, because we got to make sure that we know what's there, what should be there, what shouldn't be there, and how to take action to get it off. So you would say, okay, Heidi, enough. Start talking. How do you get started? Well, I'm going to say, here's the game plan. This is what I do for when I onboard a new client and I'm helping someone with their credit. This is how I recommend them to do it, because some of these things I recommend them to do. Some things I do more directly as a professional. I do things a little different. But I'm going to tell someone, this is what I tell someone who's going to work on their credit themselves, how they should do it. And this is a reflection of how I handle someone's credit. So the first step, I always tell them, if whether you're looking at your credit through any credit monitoring service that's not a 3 bureau service, I mean, say, Credit Karma, nothing, I'm not for or against them. I'm simply saying whether you use them or not, the important thing is that you're looking at all 3 bureaus: TransUnion, Experian, and Equifax. So however you do it, that's up to you. If you're not doing that already, and you at least want to look at your credit report to at least see what's there, say you're someone that doesn't even look at their credit, first thing you can do is absolutely free. You can go to annualcreditreport.com, and I'll have a link for it in there, but in the comments, in the description as well. But if you go to annualcreditreport.com, the government told back when credit reporting, credit repair acts first came along back in the 90s, and they said, credit is so important. Everything, people's decisions are being made this way. So the government told the credit bureaus that, look, you guys, the information that you're reporting, you're making millions of dollars reporting people's information. The burden is on you to make sure the information is accurate and true. So people need to be able to see. Remember, I told you how I couldn't see my credit to even find out why I was being denied. Well, that changed in the late 90s. I believe it was 98 or 97. Well, I think it came out in 96, but they rolled in. But late 90s, the government told the 3 credit bureaus, you have to provide one free copy of consumers' credit report every year so that they can have a chance to look at it since you guys are reporting all this information. And again, it's totally free. If you go to annualcreditreport.com, that's the correct one. Don't go to freecreditreport.com because it's not free. Annualcreditreport.com is where you go. Now, when you go in there, you have to do it 3 times because it's for each bureau. But all you do is you answer questions about your accounts that everything, whatever you got outstanding now, or sometimes they ask questions about past stuff. And they ask you questions like, did you buy a car between this day and that day? Did you ever own this, or did you ever do this? You just answer those questions. And then when you successfully answer the questions, they provide you access to your credit report. Again, one for each bureau. And you can even PDF, you can print it out by hard copy if you want it. But I can tell you, be warned, they're thick because it's your entire credit history, as well as, but I recommend get the PDF download. You can just click a button, you download the PDF onto your computer, and then you'll have a copy of it because you want to have that so you can go back later and go through everything. And it's everything. So, but you want to make sure everything is correct. So you have to do that with TransUnion, you have to do it with Experian, you have to do it a third time with Equifax. That's free. And you can do it. The beauty of it is you can do it every year. You only get one a year. So usually, and it's every 365 days. So if you were to do one on, pull one on March 1st, then you can't go back and get another one until March 1st of the next calendar year. So 365 days later, you can have access to that. But again, if you're starting out, you have no idea what's on your credit, that's free way. You can also sign up for credit monitoring companies. I have one that I use, but I'm not going to mention it in the video. If you want to know, you can look in the comments. There'll be a link for it there. And the beauty of it's all 3 bureaus, one account. But it also has some other perks too as well. And that's a lot of the credit monitoring companies. They have various benefits. They help you boost your credit, monitor your credit, alerts, things like that. Because the important thing with monitoring your credit is that you're monitoring your account for errors and for fraud and identity, which is very important. But that's the first thing you got to do. Now, after you've gotten your credit report, all 3 bureaus, however which way you want to get it, through the free source or otherwise, you want to review it thoroughly. Don't just open it up and say, oh, my score. Oh, and I want to mention to you, annualcreditreport.com does not provide scores. You can pay extra for scores, but our goal here is not the scores. I mean, we want to know the scores, but our main goal is we want access to the credit files so that we can look and see what's being reported. We're going to, for the next step. So again, going back to step 2, you want to review that credit report thoroughly. Look for errors like accounts that you don't recognize, accounts that you never had. Like there were accounts that I didn't recognize and they were negative ones, because it seems like nobody ever puts a good credit mistake on someone's credit by mistake. It's always the bad ones that end up there, and so you're looking for accounts that you don't recognize. Number 2, even your accounts that you do have and you do recognize, make sure the balances are correct. Make sure that the balances are correct on all 3 bureaus, not just one. Because if they're wrong on one, they're wrong on another, and they're wrong on a third, they don't even match. So you can question that. But you look at your statement and know you go back 30 days and say that's about where my account balance is. Not down to the dollar, but it should be, if it's substantially different, like if your balance is $800 and they're saying it's 8,000 or 1,200 or anything like that, especially with a credit card, where if the wrong balance being reported makes your credit utilization look horrible, that's having a negative impact on your credit. And on top of that, you want to look for duplicate accounts. Now, there's 2 kinds of duplicated accounts I'm going to talk about. The first one is where it's the exact same account being reported differently, and sometimes they'll have different balances. because again, for some reason, the creditor is reporting it twice and is reporting each one differently when it's really only one account. The other kind of duplicate account is not an exact duplicate. It's like this. Say you have a credit card account that for some reason you lost track of it. It went into collection. It went into default. You stopped paying. It went into default 30, 60, 90. Then it went delinquent. Then it went 120 days. It went to collections and then charged off. Right. And then usually what happens is after it's been charged off, they sell it to a third party collection agency, which they may or may not be able to do legally, or legally or under the terms of the Credit Repair Reporting Act. So then what happens is the third party collection agency, they reach out to you. You don't recognize them. You never acknowledge them. You never talk to them. They never hear from you. Then they start reporting to your credit bureau. So here it is. You got this third party collection that's reporting the same negative account technically as your original account that you let go bad in the first place. Again, duplication of negative items. And really, if the third party collection agency legitimately bought the account, then the original creditor needs to change their account. They shouldn't be still reporting you as a collection with a balance if they've sold it to somebody else, and their reporting is as a collection with a balance. So that's another type of duplication you want to watch for. So you want to take that. If you printed it out, you want to highlight any discrepancies. Obviously, if it's a digital copy, you may want to just take notes of it. Or if you can digitally highlight it with PDF, you can probably do that if you got the right one. But highlight any of those discrepancies that I just named for the next step. So step 3, you want to gather any and all supporting documentation that you may have that'll be the basis for your dispute. That'll be the reason for why you're disputing this account. And why is important, because you hear a lot of people on the internet just talking about just dispute it, just dispute it, just dispute it. Remember, disputing is you disagree. And so if you're going to disagree with somebody about something, you got to have a reason for your disagreement. They say A, you say it's X. You got to say why it's X and not A. That's your supporting documentation. Now, it could be anything from proof of payment for something that they're saying is still outstanding. It could be evidence that if it's something weird, like it was never yours and you've already proven this before, or if you say, nope, that didn't happen, or that was already taken care of, I paid it a long time ago, and all of that. You got anything like that, that's where what you're going to need it for. If they say you had a late payment and they say it was on this day and month, you provide whatever you got that says, no, it was paid on time and in full at that particular time that they reported as it being late. Could be bank statements, could be receipts, could be any kind of documentation that will back up your claim. If it's an account you say it's not yours, then that's where we're going to put the burden of proof on them, because if they say it's yours and it's not, they got to show proof that it is, and then that may be uncovering some sort of fraudulent activity or identity theft that you've been a victim of. But that's what you want to get. So now step 4, you want to draft a dispute letter. Now, there are various companies that will provide that. There are various forms you can do that. There are various services you can get to have people draft letters for you. But the important thing is that the letter has to be drafted. And the important thing I should say is that it needs to be clear and concise, explaining the error. If it's you're talking about an error account that's reporting an error, and then you provide the evidence of why it's an error. Right? So just checking my microphone, make sure it's still powered up. And then in that letter, you want to include your name, contact information, a copy of your credit report with the disputed items that you're talking about being highlighted. Now, of course, in this modern day and age, we have something that I didn't have back then. Most of the three bureaus and some of the credit monitoring services, if you're using one of them, they have a portal where you can go in and dispute items electronically directly through them. Now, I've gotten mixed responses and feedback in terms of success with that. I've had people who swore they've submitted things multiple times through the bureaus directly and they never got any response. I've had people who said they've reported that way and all they got was a letter saying we looked and everything looks fine. And so they say, oh, well, we checked. We don't know. Um, so you may encounter pushback like that or response. I should say may get results like that if you do that. You may get results like that even with a written letter. But it's hard. It's if you really feel like you can't get it that way, there's an option to always send it certified mail. But I found that people who have tried that have told me that when they send it certified mail, they send it back to sender and things of that nature. But just understanding that the dispute process is a process. So it's not a one and done. Sometimes you get lucky, you dispute something. They say, yep, you're right. Sometimes they dispute, and then you have to dispute it. You have to know when to dispute to the credit bureau first versus disputing to the creditor first. Sometimes you have to do both. You usually have to do both. If the credit bureau whoever responds first usually is going to require follow up and more disputing. So it is a process that takes time and energy. And of course, the better you are at doing it, the more efficient you get at getting responses, the language of your letter, because, and again, we're talking about disputing errors. Now, if you're actively disputing items that are not in error, once you've determined that they're not reporting an error, but maybe they shouldn't be there for other reasons, again, there's a disputing process where people talk about credit repair folks who work under the legalities of delinquent accounts, um, and then the belief that they shouldn't be there under certain statutes. That's a process too. And again, if you don't, unless you study that stuff, you don't really know how that goes. So I would say that's what you have to consider there. So, but again, there's lots of resources out there on how to get dispute letters. A lot of them claim to have the magic potion, things like Metro 2. I've heard of things like that where they say you got to put in certain words and language and highlight things and confuse the computer so it gets in front of a person. You're going to get a better dispute result. That all of that. I'm gonna be honest with you. I don't really believe in a lot of that stuff. There's no magic potions. There's no hacks. There's nothing like that that will help you in that way that I've seen. So I say I go old school and just let's just do the right thing and have them do the right thing, and we get the results we want. Now, this next step, this is the one you submit your dispute. So you can dispute it, like I said, online through a portal or actual mail. Now, for my clients, I dispute by mail because I like to make sure that they get a letter and that the letter is processed. And I always get responses from my clients by disputing that way, right? So it may take more time, but it's better to have a slow yes than a fast no or lack of response. Now, when you send your documents, make sure you send copies. Don't send them your originals. You always want to keep your originals for your file. Make them copies, include them with the letter. And then the letters get reviewed along with the documentation. The documentation explains the letter. The documentation supports the letters. The letters explain the documentation, give it context. And so then you sit back and you wait. Now, here's the part that kind of sucks. Credit bureaus and creditors have 30 days from when they receive your dispute letters, when they receive your dispute request, whether it's electronic or by mail. They got 30 days from when they receive it to investigate your dispute and give you a decision. right? And that's the part where you have to wait. So you want to make sure you take your time up front and have your dispute together and have basis for it. Otherwise, you're just going to waste a lot of time. And when you're hiring someone to do this for you in the credit repair space, you want to make sure that they are doing the same, that they're just not just throwing out letters, collecting your money and just throwing out letters. They're just disputing any and everything with no real basis. They just disputing. And a lot of them just dispute everything as error, even though they're not proving it, just to try to get a stall out during the investigation process. So be wary of those folks. So follow up. Step 6 is follow up. After that 30 days, you want to keep track of that. And so then if you haven't received anything from them and within that 30 days, after factoring in, it took them maybe 3 days to a week to receive your request if you did it by mail. And so then you want to keep track. So because you want to know, when should I follow up? When do I, if I haven't heard anything, how do I follow up to hear back? Usually it's with a follow-up letter. Again, when someone's skilled in that, we have, or you may have access to a credit dispute letter library, which will have letters already formatted for you on how to respond, because you'll have a letter. If they responded and they said yes, because a lot of credit repair, when it comes to disputing, is if-thens. If they say this, then we do this. If they say this, then we do that. If they do this, we do this. So it's hard to talk about what the next step is going to be, because the next step is like this. If this happened, then we do this. If this happened, we do this. If another thing happened, we do this, and so on and so forth. But that's the basic dispute process, the cycle, if you will, of reviewing your credit, disputing, finding out what's on there that's not shouldn't be there. Is it an error? And based on whether it's an error or something that you don't think should be there or whatever, are you asking for them to correct something or remove something? So all of those are if-thens that make talking about credit repair very complicated, because there's a bunch of if-then statements, or if-then actions, I should say. And so, but that's so you follow up, you send back another letter, look for a response, and then the cycle repeats itself. That's why I tell people, you're repairing your credit, it's a process and it takes time. That's why I tell people, it depending on how many items you have and what you have, it could take as little as 30 days. It could take as long as a year, depending on what you have. But I will tell you this, it's worth it. The long-term benefits are well worth the short-term pain, which you might not consider 6 months, 3 to 6 months, or maybe up to a year to fix your credit as being short-term. But it is 6 months to a year short-term in your whole lifespan. That's a small amount. So I think it's worth it. And that's the only way to really grow those roots so that you can sprout up with a new good credit. All right. So I'm going to give you a quick pro tip on this. If the dispute doesn't resolve in your favor, you can add a statement to your credit report explaining that your side of the story. You can explain any negative history on there. Most people don't talk about that. It used to be a big thing when we talked about explaining negative items. And of course, that comes into play more when you're doing something like a mortgage, where there's a live person making the ultimate decision. A lot of credit products and a lot of things are done automated, and they simply go by score and whatever it spits out when they put your credit report. But then there's an appeal process as well. But especially for those of you who are looking to get a mortgage, if you got negative items that are legitimate, you can't dispute them away. They are part of your file. They will be until they die off on the vine. And I'm not talking about collections that are unpaid and you think they're going to fall off in 7 years, because that's a fallacy. Because I always ask people when they say, oh, they're going to fall off after 7 years. And I always say, 7 years from when? And nobody can ever answer that question, because the truth is Collections only fall off your credit report after 7 years from the date of last activity. And if you look on your credit report, you'll see a line on every account that says date of last activity. And in most cases, the date of last activity is last month. So they update the date of last activity every month so that the credit debt clock that everybody is looking for a collection to fall off never actually starts. It only gets 30 days old. Now, I have seen a number of times where if the collection was small enough and old enough, where the creditor stopped, even the collection agency stopped even reporting it as a collection. That's usually on the third party collection side, where they it's a small, so they've even given up on collecting on you, and they forget to keep reporting it every month. Sometimes they'll switch and they may only report it once a quarter, twice a year, once a year. Some of them forget to report altogether, and I've seen people with collections that are 5 years old, 5 years from the date of last activity. And so I tell them, well, here's the deal with those. If they've forgotten, it's a chance that they may forget, and then after 7 years they'll stop reporting and it'll fall away on its own. But what could possibly happen is they've forgotten, and at some point they have some sort of internal audit process, and they may go, oh shoot, this one's near 7 years, let's update the date of last activity to refresh it. And guess what happens then? The clock sets all over again and you go back to 7. But if you're 5+ years with no data last activity on the collection account, I would say wait it out. The worst that can happen is, now they could refresh it as all the way up to day 364 from data last activity. But if you leave it alone and it falls through, then you're fine. If it doesn't, oh well, the clock starts over and now you can handle it accordingly. So that's what the debt clock is all about. So all those people out there that are sitting around ignoring their collections and their charge-offs because they think that they're going to fall off after 7 years, that's not the case. And for those of you who say don't pay your charge-offs because they're not legally supposed to be reporting you as a charge-off if they've written it off to the IRS, but there's a catch to that, and that's true. They are not supposed to be reporting charge-offs on your credit report because let me explain what a charge-off is. A charge-off is when your account that's in a lender's system, the lenders have to pay taxes on it because the IRS considers for a lender all their outstanding accounts as an asset because it makes money they make money by collecting the payments due on those accounts. So they report it as assets on their balance sheet every quarter, and they pay taxes on it. So what happens is once an account goes past 120 days, day 121 is considered, it can be eligible for charge off. That means the lender can go to the IRS and say, these accounts are 120 days old. We have not talked to or heard from this borrower in over 120 days. We deem that the account is uncollectible. We don't think we're going to ever go get our money. So we want to take it off of our books so we don't have to pay taxes on it anymore. You say, why does that matter? Well, if I'm a big lender and I got tens or thousands of accounts, all those tax bills associated with those accounts could be substantial. So once they do that, so the IRS says, okay, fine. In order for you to charge it off, you got to generate at the end of the year that you're writing it off. You have to send that consumer a 1099 for the amount that you forgave on the balance, that the amount that you gave up on. And so then the consumer, under the law, this was something Trump did when he was in office. I'm not getting political, but I'm just saying it was under his watch where the IRS said if a creditor charges off a debt, they can generate a 1099, and then the borrower would have to consider that forgiven debt as income. But technically, under the law, the charge off is not valid if the 1099 was never issued. So if you got a collection that's beyond the calendar year that it was charged off, and you never received a 1099, then that's something that would work on to get removed. That I would get work to get removed because it's not there legally. Now the question is, most cases I found that people, they either never received a 1099 or they never remember. A lot of people who did actually receive 1099s on substantial size debts, they ignored the 1099 because they had no idea why would they be getting a 1099. That was not income, so they think it was some sort of error. But if you had a large charge off, say a 5-digit car loan, $10,000 or more, and if they charged it off, and it's been more, now we're in a different calendar year, you should be looking for a 1099. If you haven't, you should be looking for somebody like me, or even possibly try to do it yourself, to say, hey, I never received a 1099. Therefore, if this was charged off, it shouldn't be reporting as a charge off if they never issued me a 1099. That's something you could do with that. But again, that's part of the complexity of negative items on your credit and the complexities of disputing on your negative items on your credit report. So there you have it. There's sort of a step-by-step guide in the basics of disputing negative items on your credit report. Now remember, with that follow-up part especially, persistence is the key. Every step you take brings you closer to that, better credit, health, strength, quality. I use those words interchangeably to get you that higher credit score. Now, every step brings you closer to better credit, a better life. Every step you take gets you closer to the best credit you could possibly have. So hopefully you found this helpful. If you want more information, I'd say watch some of my other videos. I talk about other aspects of building and repairing your credit as well. But if you want me to dive deeper into these subjects, put a comment in below, and because I'm working to try to make videos that you guys really care about, with information that really helps you. And so it's better for you to tell me what you want me to talk about, and I can most certainly do that. I can speak to just about anything in terms of credit. And also as well, I hope that if you like this, you hit the like button. If you subscribe, so you get the notifications, so as I make more videos, you'll be notified of them. And share this with people you think that can benefit from this, people that need to know this, others that are working on the struggle to fix your credit, to fix their credit, build their credit, and then have better credit for a better life. So thanks for your attention. God bless, and see you on the next video. Take care.